Oil price gains after the Hormuz vessel incident could tighten margins for energy holdings in Canadian portfolios, so review position sizes before the next OPEC update. This is Modern Investing Techniques, episode 127. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Global shares rose modestly while oil prices climbed on the Strait of Hormuz incident. The TSX Composite closed at 35,226, down 0.8%. The S&P 500 sits near fresh record territory as AI trade leadership shows signs of broadening. The Bank of Canada decision sits 2 weeks out with markets pricing a hold. The Nasdaq Composite closed at 25,914 with a year-to-date gain of 11.53%. The simulated portfolio's matched window alpha stands at plus 5.37% across 38 benchmark trades. That leaves the buy and hold gap versus the index negative at 10.94% year-to-date. Earnings season continues with beats from Revvity and Palantir underscoring commercial AI demand. About 25 days ago, we picked DAL on an earnings surprise thesis that closed down 1.41%. That outcome reminds us even strong revenue prints can falter when fuel cost assumptions shift. High-yield closed-end funds in a TFSA can generate monthly income near 12 to 14% when discounts to NAV are monitored. Positions rotate on leverage or payout risk signals. Today's environment of geopolitical oil pressure and mixed equity breadth makes active CEF oversight more relevant than static high-yield indexing. Investors maintain a 6 to 8 fund basket. They track each holding's discount or premium, NAV trend, and leverage ratio on a monthly checklist. Names like FFN or DFN get swapped when metrics deteriorate. The approach has historically delivered steady cash flow in sideways or mildly bullish markets. It carries NAV erosion risk during sharp rate spikes or sector-specific drawdowns. Platforms such as Questrade or Wealthsimple allow easy monthly rebalancing without commissions. The TFSA structure shelters the distributions from immediate tax drag. The key is treating the holdings as actively managed income vehicles rather than set-and-forget products. A Reddit user running this exact strategy on a $100,000 TFSA currently holds BK, Bank, Utes, LFE, QQQY, and QQCL. That basket collects roughly $1,200 per month at a 14% yield, while still seeing some capital appreciation. Monthly reviews focus on NAV stability, premium or discount levels, and leverage ratios. Swaps execute when any metric signals rising risk. This hands-on rotation has kept the portfolio inside the target yield band without large drawdowns so far. The TFSA's tax sheltering amplifies the compounding effect of reinvested distributions, turning the 14% payout into a powerful long-term growth engine when monitored consistently. This is a simulated trade for educational purposes only. No real money is involved. This is not financial advice. Today's pick is none. We are monitoring AAPL. The strategy watches for volume confirmation above the 20-day average on any pullback to the 50-day moving average. The catalyst remains continued commercial AI demand visible in Magnificent 7 earnings breadth. Price action sits relative to the 50-day and 200-day moving averages. Volume versus the 20-day average serves as the trigger. Geopolitical headlines could widen spreads. No entry occurs until the volume threshold is met. Confidence sits at medium because two factors align, yet geopolitical uncertainty remains. Monitoring a single name for a specific volume trigger demonstrates how to wait for confirmation rather than chasing headlines. That builds the discipline separating systematic entries from reactive ones. Text-positive historical alpha record still requires fresh data before committing capital. The Magnificent 7 group just posted a collective move not seen since ChatGPT's launch. Breadth is expanding beyond the original AI leaders. That reduces concentration risk, but also means any single name like AAPL needs independent volume confirmation before an entry. Geopolitical tension in the Strait of Hormuz adds a layer of macro volatility that could trigger short-term swings unrelated to fundamentals. Waiting for the 20-day volume average to be exceeded filters out noise. It aligns the trade with the regime that has produced the sector's strongest alpha historically. We simulated buying DAL at Monday's open 25 days ago. The position closed down 1.41%. Revenue beat expectations, yet fuel cost assumptions shifted the outcome. This teaches us that even clear earnings surprises require cross-checks on sector-specific variables like commodity inputs. The lesson reinforces valuation discipline when macro variables move faster than initial models anticipate. Descartes Free Trade Intelligence scans sourcing and tariff data to flag lower-cost trade routes for importers and exporters. Canadian investors running cross-border supply chain exposure can use it to stress test tariff scenarios before earnings season. Access comes through Descartes Systems Group Enterprise Licensing. The tool integrates real-time trade intelligence with AI models that evaluate duty rates, free trade agreement eligibility, and alternative supplier locations. Manufacturers and logistics operators can model the impact of new tariffs or shipping disruptions on landed cost before committing to contracts. This reduces the chance of margin surprises during quarterly reporting. Fidelity publishes a curated roster of 15 index funds that meet internal cost and performance screens. Investors can overlay this list against their TFSA holdings to identify lower fee alternatives without building screens from scratch. The list updates periodically and remains free to view on Fidelity's site. The selection process emphasizes low expense ratios, tracking error, and liquidity. Canadian investors can compare these funds against TSX-listed equivalents to decide whether a U.S. domiciled vehicle offers better after-tax efficiency inside a TFSA or RRSP. Because the list refreshes regularly, it serves as a low-effort way to keep portfolio costs in line with evolving market conditions. Musk likely faces tough questions during SpaceX's first earnings call as a public company. Investors gain direct access to management commentary on valuation and growth assumptions after the public listing. Add SpaceX-related exposure via any listed proxies to the watch list for post-call volatility. An Ontario antimony deposit is being positioned for U.S. defense supply chain inclusion. The project aims to meet domestic content rules that could unlock procurement contracts and strategic stockpile purchases. Review any precious metals or critical minerals holdings for policy-driven re-rating potential. Revity beats estimates and raises guidance as the stock jumps. The beat and raised outlook triggered immediate price strength on healthcare demand signals. Add Revity to the healthcare watch list for any follow-through volume above its 20-day average. Clean Energy expands its fueling network as trucking and refuse fleets across Canada choose natural gas. New Western Canada agreements expand renewable natural gas infrastructure for fleet operators. Consider adding CLNE to the energy watch list if natural gas adoption metrics continue rising. The simulated portfolio across 38 benchmark trades shows a matched window alpha of plus 5.37%. Our AI analysis continues learning from patterns like volume confirmation and sector breadth. Adjustments focus on waiting for confirmation rather than headline reactions. Imagine you added a Canadian bank stock to your TFSA last quarter, expecting steady income. The dividend arrived, yet the after-tax yield looked different once compared to a U.S. name in the same account. Eligible Canadian dividends qualify for the dividend tax credit. That credit can reduce the effective tax rate to near zero for investors in lower brackets. The Canadian Dividend Aristocrats list supplies names with 22.5 plus years of increases. Sustainability hinges on payout ratios below 60% of free cash flow and coverage ratios above 1.5 times. Dividend growth strategies have outperformed high-yield approaches over full market cycles. They compound at lower initial yields while avoiding payout cuts during recessions. DRIP programs at the big banks and pipelines let you reinvest automatically inside the TFSA without triggering contribution room issues. The bank pipeline telecom oligopoly gives these names pricing power that supports payouts through commodity cycles. Stuffing a TFSA with a diversified basket of these names remains popular because the tax credit and contribution room growth compound together. The biggest misconception is assuming any high yield is sustainable. Always cross-check free cash flow coverage before adding size. Investors often overlook that the gross up and tax credit mechanism applies only to eligible Canadian dividends. It does not apply to foreign dividends or distributions from U.S. companies held inside the same account. This distinction matters when constructing a TFSA because a 4% yield from a Canadian bank can deliver more after-tax cash than a 5% yield from a U.S. utility once foreign withholding tax is factored in. Free cash flow coverage above 1.5 times provides a buffer during economic slowdowns. Companies can maintain or grow dividends even when earnings dip temporarily. The Big Five banks and major pipelines have demonstrated this resilience across multiple cycles. Automatic DRIP enrollment inside a TFSA also avoids any cash drag. It keeps the full contribution room available for new deposits each year. The strategy's edge comes from combining the tax credit with the TFSA's tax-free growth. That edge holds only when the underlying holdings maintain sustainable payout ratios supported by actual cash generation rather than debt-funded distributions. Open your brokerage app, pull up the 50-day moving average on AAPL, and set a price alert 3% below that level. Note the current distance to the alert in your watch list. Before we wrap, watch for any volume spike above the 20-day average on AAPL ahead of the Bank of Canada decision. That's it for today's Modern Investing Techniques. The resources page has links to everything we discussed. Subscribe and share with someone who wants to go beyond index funds. See you tomorrow. And if you'd rather watch than listen, find us on YouTube at NARA Network. Links in the show notes. This show comes to you from the NARA Network. If you want another sharp daily briefing, OmniView has you covered. A balanced daily world news briefing that takes every side seriously. All our shows are free at naranetwork.com, and on the website, every episode's visuals live in our free image gallery at naranetwork.com/gallery. Royalty-free under Creative Commons, download with attribution. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking